Welcome to the Mortgage Rate Weekly Market Update for the week of December 23rd, 2018. Hope you guys are all ready for the holidays. We got an early Christmas present with the bond market. If you take a look at the bond chart on the screen there, you can see mortgage bonds have been rallying off of the floor of support they hit back in November. So in November, mortgage rates were at a 7-year high. And since then, mortgage rates have been moving lower as the bond market has been able to rally, as you can see. Now, last Tuesday, mortgage bonds finally broke above the 200-day moving average. You can see there on the graph. That is huge. We haven't been above the 200-day moving average for a very long time. And then last week, we were able to sustain that rally all week, stayed above the 200-day moving average. So that has been confirmed as a very strong floor of support moving forward. As we start the week on Monday, we've got shortened trading day today on Monday, but mortgage bonds are rallying at the benefit of the stock market, which is selling off. So as the stock market continues to sell off, you're going to see mortgage bonds benefit from that, and that could move interest rates slightly lower. So with the stock market selling off, bond market above the 200-day moving average, we're going to recommend floating your mortgage interest rate to start the week. But be careful after the holidays. If the stock market is able to mount a relief rally, to find a floor of support and bounce off of that, mortgage bonds would probably sell off at that point. So we would quickly switch to a locking stance to take advantage of these better rates you have gotten. You haven't seen these better rates since May of 2018, all the way back in the spring. So go ahead and float your mortgage rate as we go into the holidays, but be conscious of stock market reversal. But we are down as we go into the holidays in the stock market, so mortgage rates are down as well. Now, if we dig into the economic news, big news last week, Federal Reserve had their meeting, and in their meeting, they did raise the Fed funds rate 0.25% to 2.5%, as you can see there on the screen. They've been raising it and raising it each meeting. They decide whether they're going to raise it or not. So in December, everyone was expecting them to raise it. But what shocked the market, and this actually caused stocks to sell off last week, was at the statement after they raised the Fed funds rate, stocks were hoping for a more dovish statement, but the Feds have been saying they're going to raise interest rates 3 more times in 2019. Everyone was hoping that would not happen. So they said that they're not going to raise it 3, but they are going to raise it 2 more times in 2019. So that's a little more hawkish than the market was hoping for. That is why the stock market sold off last week after the Fed statement. Now, as we move into 2019, what's going to happen with mortgage rates? Well, the Feds are going to be selling in 2019. It's going to be a big year for selling treasuries and government bonds. Now, the Fed is no longer a buyer of bonds and treasuries. So with this increased supply on the market and the Fed's not being in the market to buy them to help the market, we're looking for mortgage interest rates to rise throughout 2019 as the Fed puts out the market a huge release of treasuries and bonds. The market will not be able to absorb that without the Fed, so we will see mortgage interest rates move higher. So that means if you're looking to buy a home, now's the time to get out there and buy. Take advantage of this relief rally we've seen in mortgage rates. Find a house and get under contract. All right, then we saw a measure of inflation. The Fed's favorite measure of inflation is the PCE, or personal consumption expenditure, for November 2018. That fell from 2% to 1.8% on a year-over-year basis. So it's slightly below their target of 2% now, which means inflation is cooling off, and the drop was related to the drop in oil prices. As you may have noticed at the pump, you've seen the cost of gasoline going down. That's because oil prices have been going down. Then we had the final reading of the gross domestic product, or GDP, for the third quarter. It came in at 3.4%. That was down from 3.5% in the second reading. But anything over 3% means the economy is doing well. So 3% GDP is good news. So as we move into the fourth quarter, we are at 3.4%. That's a good reading on GDP. Then we saw weak initial jobless claims come out on Thursday. They did go up 8,000 claims to 214,000 claims for the week, but that's still really low. And we had broken that streak of jobless claims moving higher. We broke that the previous week, and we're still well below that this week. This week's numbers are also going to be the sample week used in the jobs report, which for December, which will come out January 4th. So this reading points to a good jobs report. Now, there's obviously other factors, but just if we look at weak initial jobs claims, that does point to a good jobs report. Now, housing news. We got a couple reports there. The first one we saw, housing starts from November 2018 rose 3.2% from October on an annualized basis to 1.256 million units. Now, housing starts measure the number of new homes builders have started construction on. But if we dig into the report, it's not all great news. Most of the gains, actually all the gains, were in multifamily starts, because single-family construction, which is the best measure of the housing market, fell by 40,000 units. So even though on the surface looked like a good report, housing starts for single-family construction actually went down. Now, building permits for November 2018 rose by 5% to 1.328 million units on an annualized basis. But building permits is a sign of future construction. But if we dig into the report again, the increase was all in multi-family starts and not single-family houses. Single-family housing drives the market, so an increase in multi-family units does not help the single-family. But what it does show is there's increased demand for rental units. Now, we saw existing home sales for November 2018 were up 1.9% from October to 5.22 million units on an annualized basis. This was the second increase in the last 6 months, but sales are still down 7% year over year, and the biggest reason is inventory. If we look, inventory increased 4.2% year over year, but from last month it actually dropped from 1.85 million units to 1.74 million units. And we measure supply on a monthly basis, so that dropped from 4.3 last month to 3.9 months of supply of homes this month. So the low inventory is what is hurting the sale of existing homes. There's not enough homes for sale. We do have the buyers, there's not enough homes, so that's why the number of homes being sold is not where it could be. Now, the median home price of an existing home sale actually did go up to $257,700, which is an increase of 4.2% year over year. And if we dig into that report on existing home sales, we saw first-time home buyers moved up from 31% of the buyers to 33% of the buyers, and cash buyers dropped from 23 to 21%. So it's showing that new first-time home buyers are becoming a bigger part of the market. So if you are a first-time home buyer, now's the time to get out there and start buying. And another good news, the FHA, or Federal Housing Administration, announced their loan limits for 2019, and they increased by almost 7% across the board. So that's huge news. They kind of followed conforming loan limits had announced previously they were being increased, so FHA followed, increased theirs by 7%. In the blog, you can get a link for a website where you can check the limit for the county anywhere in the United States. But the Delaware itself went up in all 3 counties. So Newcastle County is up to $402,500. Kent County is now above $300,000. It's up to $314,827, and Sussex is up to $336,950. So those are the maximum loan limits you can do for an FHA loan. Conventional is higher at $484,500. So if you're buying a bigger home and you can't go FHA, we can always look at conventional to get you higher loan to value. Now, in the local news, we got the next first-time homebuyer seminar coming up Saturday, January 12th. That's in Newark, Delaware, at the Christiana Hilton Hotel from 10 a.m. to noon. And then we are back in Wilmington on Wednesday, January 23rd from 6 to 8 p.m. in Independence Mall at eXp Realty office. You can register for either one of those events, but give us a call at 302-703-0727 or online www.DelawareHomebuyerSeminars.com. And then we are back in Maryland on Saturday, January 19th in Edgemoor, Maryland. That's from 10 a.m. to noon. You can register for that event calling us at 410-412-3319 or online www.MarylandHomebuyerSeminars.com. Look forward to seeing you guys next week.